So welcome to another episode. As usual, we get to talk about money, how it works, how it grows, and how to get the best value out of your money for you. Today, we want to talk about mutual funds. Another expression that is used for mutual funds is collective investment schemes or CISs. But how do mutual funds work? Now, I would focus today on talking about money market mutual funds, just so that people have a better sense of the most common ones and the largest ones, and then we can talk about some of the details afterwards. So in order to get a good understanding of this video, you should look at my video on bonds, you should look at my video on treasury bills, and also my video on risk, because it helps to understand how this works. But essentially, mutual funds are collective investment schemes for a reason. It means they pool money from multiple people and multiple places into one pot, and the whole pot is administered. Now, given the way the regulatory environment in Ghana works, and also because money market instruments are typically lower risk, or our mutual funds want to lower our risk. So effectively, they'll be investing in asset classes that are lower risk. What are some of the low risk asset classes? Treasury bills, government securities, maybe some overnight securities with the banks. These are typically your lower risk asset class. So they don't promise you a very high return, but they tend to promise you a consistent return that doesn't change much and is less likely to be lost. You are less likely to lose your money because it's lower risk. Now, mind you, for a long time, people have considered treasury bills as risk-free. But the truth is, there's nothing in this world that is risk-free. Every investment has a risk. The fact that the risk is very low doesn't mean the risk is zero. As long as you are alive in this world, there's a risk associated with what you are doing, whether or not it is visibly high or it's extremely low. It's there. So because these asset classes, that is bonds, treasury bills, overnight instruments, are typically what you can invest in for money market funds, of course, they do keep some cash. Whenever bonds and treasury bills start to perform differently, then money market instruments respond to that performance. What does that mean? When bond markets start to act differently, or treasury bills start to act differently, or the banks start to act differently, essentially what is happening is that the instruments or the assets or the types of investments that have been made by these mutual funds will also respond. Classic example is if the bond market is acting funny. In this case, if the bond market is having difficulty selling those 100 Ghana Cedi checks as per the previous episode at the right price, then people who are trying to withdraw from the mutual fund will experience the same problem. Now, let me explain this properly so you understand me. The bond market is going through a downtime, so people are buying bonds for low prices. But your mutual fund has invested in bonds. So if you want to withdraw your money can't be given to you except they sell some of the bonds that they bought. Now, in the previous episode, we spoke about why the bond prices change. But basically, 100 Ghana Cedi bond is selling today for, say, 75 cedis. So if you go withdrawing your 10,000 cedis, when the collective investment scheme tries to sell the bond, they will be able to only get 7,500 cedis. So that is what you will get. So the collective investment scheme doesn't do anything with your money for themselves. They take your money and they invest in instruments that exist in the market today. And so whatever happens in the market tends to happen to your collective investment scheme. But if you are invested in a scheme that didn't buy bonds and only treasury bills and nothing happens to treasury bills, then you will be in a different soup. If you are invested in a scheme that didn't invest in any of this and kept only their cash, you will also be in a different scheme. But generally speaking, the collective investment schemes that invest in money market instruments don't have too many options to invest in, so they tend to respond similarly. If you have a different one, awesome. But if you are in any of the ones that are In this particular situation where withdrawals have become a challenge, this is the reason why. They took your money, they invested in low risk instruments, which means the chance of failure is low. But as I said, the chance of failure is not zero. So sometimes, maybe once in every 40 years, once in every 30 years, once in every 5 years, who knows, the markets can swing. But then again, just give it time. The mutual funds will respond. But I hope this gives you a bit more clarity on how mutual funds work. Now, there's another category of mutual funds that are not money market instruments, and those are mutual funds that invest in higher risk instruments. For those, it's a very different story. If you invested in a mutual fund that focused on buying stocks, for example, then your price will keep changing all the time. It could go negative, it could go 300%, it could go 1,000,000%, depending on the stock market. But most of us tend to want low risk, and we invested in low risk instruments. And at this time, low risk instruments have gone through a phase because of macroeconomic situations. So we shouldn't rush, we shouldn't panic. They are still low risk. We just have to give them time to adjust. Hope that helps. Then again, nice reminder and gentle reminder, money grows slowly and consistently. We know there are people out there doubling money. Most of us know Warren Buffett. He started investing at 11. He became a billionaire at 60. There are not many people who have doubled money. And for many of them who have doubled money, they tend to have lost it as quickly as it came. Build like the ant. Consistently, slowly, every day until you have a huge mountain. Think like an ant. Have a good one.